This US-China silver war could change everything. What if the most important economic war on Earth wasn't happening on battlefields, wasn't announced in headlines, and wasn't reflected in the price on your screen? What if it was already underway, quietly, methodically? Inside supply chains, refineries, and contracts most people have never heard of. While markets argue over charts, while investors debate bubbles and crashes, two superpowers are fighting over something far more dangerous than money: control. Control of a metal that underpins industry, energy, technology, and the next global financial system. And here's the unsettling part. By the time governments acknowledge it, by the time policy is announced, the outcome is usually already decided. The question is not if this silver war changes everything. The question is whether you'll understand it before the consequences become irreversible. Now, welcome to Boring Currency Reports. If you've been watching global markets longer than most people have been watching YouTube, this channel is for you. And if you believe experience matters more than noise, you may want to quietly subscribe. Not because it's exciting, but because missing shifts like this has a habit of becoming very expensive. And before we begin, tell us in the comments. From where in the world are you watching this unfold? They had been taught to watch prices, charts, candles, support levels, breakouts. For decades, price had been the signal that mattered most. But silver no longer obeyed that rule. On the surface, everything looked familiar. Silver moved up, then down. Commentators argued about technical patterns. Analysts debated whether the market had peaked or corrected. To most observers, this appeared to be a normal commodity cycle. It was not. Beneath the price, something far more important had changed, and almost no one was paying attention. The conflict surrounding silver was not being fought on trading screens or futures exchanges. It was being fought far earlier, far upstream, in places most investors never look: mines, refineries, shipping routes, long-term supply contracts. This was not a market battle, it was a control battle. Silver had quietly crossed a line. It was no longer just a metal traded for profit. It had become a strategic asset. And when assets become strategic, price becomes secondary. Those who understood this stopped asking where silver would trade next week. They started asking a different question: who controls the physical supply? That question changed everything. Silver is embedded in modern life in ways most people underestimate. It is essential for electronics, solar energy, defense systems, medical equipment, and advanced manufacturing. There are a few substitutes, and efficiency gains cannot eliminate the need for it. Demand is structural, not optional. At the same time, silver supply is fragile. Most silver is produced as a byproduct of other metals. This limits the ability of supply to respond quickly to rising demand. New mines take years to develop. Refining capacity is finite. Logistics matter. This is where the illusion begins. Market prices suggest availability. Exchange inventories suggest abundance. Reports create a sense of transparency. But these indicators only measure what enters the visible system. They do not measure what never arrives. And increasingly, silver was never arriving. Large volumes of physical silver were being diverted before reaching public markets, not sold through exchanges, not recorded in familiar vault reports, not exposed to price discovery. Instead, they were secured privately, quietly, and for the long term. It still existed physically, but it no longer existed for the market. This behavior made little sense to traders. It made perfect sense to strategists. In financial markets, most buyers hedge. They protect against price swings. They care deeply about timing. Strategic buyers behave differently. They care about access, continuity, and control. Price volatility is secondary. When a nation or system decides a material is critical, the objective is not to buy cheaply. The objective is to ensure supply. This is the lens through which silver must now be understood. The global system was entering an era of fragmentation. Trust between major powers was eroding. Supply chains were no longer neutral. Energy, food, semiconductors, and metals were being reclassified as matters of national security. Silver joined that list quietly. The battlefield was invisible because it did not look like war. There were no sanctions, no speeches, no emergency summits. Instead, contracts were signed, capacity was booked, supply was redirected. Those watching prices saw noise. Those watching flows saw intent. And this distinction matters. Price tells a story about today. Control tells a story about tomorrow. History shows that when institutions compete for physical resources, markets react last. By the time policy is public, supply has already moved. By the time prices reflect scarcity, access has already narrowed. This is why silver's price appeared confusing. It lagged the reality beneath it. For decision makers, this misalignment is dangerous. Models fail when rules change. Procurement strategies fail when supply is locked upstream. Investment assumptions fail when price is no longer the primary signal. Silver was entering a phase where traditional analysis became a liability. The illusion of price persists longest among those most comfortable with it. The invisible battlefield exists precisely because it does not announce itself. It reveals itself only through anomalies. bottlenecks, inventory stress, vanishing supply, behavior that no longer fits old models. Silver should no longer be analyzed as a normal commodity. The price is no longer the battlefield. It is the echo. The real conflict is upstream. And those who understand that early gain time, how control moved upstream. Before anyone noticed, they did not announce it. They did not debate it on television. And they did not wait for permission from markets. They simply moved upstream. While investors focused on price movements and short-term cycles, a different strategy was unfolding far from trading screens. It did not rely on speed. It relied on patience. And most importantly, it relied on understanding where real power in commodities actually begins. Not at the exchange, not in the vault, but at the source. Silver does not appear magically in markets. Before it becomes a bar, a coin, or a futures contract, it begins as rock pulled from the ground. That ground is concentrated in a small number of regions. Latin America dominates global silver production. A handful of countries supply the majority of the world's mined silver. Whoever secures that flow secures leverage. Instead of competing openly in global markets, one system chose a different path. It went directly to the producers. It approached mining companies not as traders, but as long-term partners. The message was simple and difficult to refuse. Guaranteed demand, long-term contracts, premium pricing, no exposure to market volatility. These were not spot purchases. They were offtake agreements. Contracts that ensured future production would be sold before it ever reached a public exchange. This distinction is critical. When silver is sold through exchanges, price discovery occurs. Competing buyers bid, transparency exists, supply is visible. But when silver is sold upstream, before refinement and before exchange delivery, it disappears from the visible system entirely. It still exists physically, but it no longer exists to the market. For a mine operator, the decision was straightforward. Mining is capital intensive. Cash flow matters more than theoretical upside. A guaranteed buyer offering certainty for years removes risk. It stabilizes operations. It protects margins. From the producer's perspective, it was good business. From the market's perspective, it was a slow drain. Over time, these agreements accumulated. One mine did not matter. 10 mines raised eyebrows. Hundreds changed the structure of supply itself. Silver that would normally pass through Western refineries and global exchanges was rerouted into a closed system. The metal moved quietly across borders, was refined privately, and entered strategic inventories instead of open markets. No alarm was triggered because nothing appeared broken. Prices still moved, reports were still published, markets still functioned. But the foundation was thinning. This approach revealed a deep understanding of how commodity power works. Price is the last signal, not the first. Control is established long before scarcity becomes visible. By the time prices react, the strategic advantage has already been secured. This was not hoarding, it was positioning. Silver's role in technology and energy made it essential for long-term industrial planning. Securing upstream supply reduced exposure to future disruptions. It insulated domestic industries from external shocks. It ensured that growth plans were not hostage to global markets. This strategy also avoided confrontation. Buying openly drives prices higher and attracts attention. Buying upstream keeps prices stable while access quietly shifts. The market remains calm even as its structure changes. That calm was misleading. Over several years, Western observers missed the pattern. They analyzed charts instead of contracts. They watched inventories without asking why replenishment was slowing. They focused on demand projections without tracking where supply was being diverted. By the time the implications became clear, the easy access phase was over. What made this strategy especially effective was that it exploited assumptions. Many believed commodities would always flow to the highest bidder in open markets. Many assumed globalization ensured neutrality. Many believed efficiency mattered more than control. Those assumptions no longer held. Silver had become too important to leave exposed. The upstream strategy also created a secondary effect. As visible supply declined, volatility increased. But volatility did not deter strategic buyers. It deterred speculators. Weak hands were shaken out while strong hands accumulated quietly. This divergence confused analysts. Traditional models struggled to explain why certain behaviors no longer matched historical patterns. The reason was simple. The buyer had changed. Markets were no longer dealing primarily with traders seeking profit. They were dealing with entities seeking security. Security does not hedge. Security does not wait for pullbacks. Security does not sell because of sentiment. Security buys because access matters more than price. By the time this reality began to surface, the structure of the silver market had already shifted. The visible system was thinner, more fragile, and more sensitive to disruptions. A market that once relied on abundance now relied on timing. This is how control moved upstream without noise, not through dominance, not through force, but through contracts. And once upstream control is established, reversing it becomes difficult. New supply cannot appear quickly. Relationships cannot be rebuilt overnight. Infrastructure takes years to replicate. This is why upstream strategies matter more than headlines. In the next part, the story reaches its inflection point, the moment when the imbalance became too large to ignore, and the counter-move began. The moment the flow changed direction. For a long time, nothing appeared to break. Silver still traded, ships still moved, reports still arrived on schedule, but inside the system, pressure was building. Supply chains do not announce stress the way prices do. They signal it through delays, congestion, and inefficiencies that appear temporary until they are not. This is how the next phase began. Quietly, indirectly, almost invisibly. Refineries noticed first. Facilities that had processed predictable volumes for years began receiving more material than expected. Concentrate arrived early. Then more arrived, then even more. Delivery schedules tightened, storage filled, processing queues lengthened. This was not driven by a surge in global demand. It was driven by a redirection of supply. Silver was no longer flowing the way it used to. Historically, much of the world's silver followed a familiar path. Ore was mined in Latin America, refined regionally or abroad, then distributed through global hubs. London and Asia played central roles in this circulation. The system was efficient, balanced, and largely unquestioned. That balance began to shift. Material that would normally move across oceans was staying closer to its origin. Shipments were being rerouted. Refining was being concentrated. The Western Hemisphere was absorbing more of its own output instead of exporting it. This mattered. Refinery congestion is not a market signal. It is a policy signal. Markets respond to incentives. Refineries respond to direction. They process what arrives. When volumes exceed capacity, it means someone upstream decided that speed mattered more than optimization. That decision was not made by traders. The accumulation of these signals pointed to a coordinated response. Not announced, not formalized, but real. The system was adapting to an emerging vulnerability. For years, the visible supply of silver had thinned. Inventory levels had declined. Dependence on foreign processing had increased. Strategic planners understood what markets had ignored. Access was becoming conditional. In an environment of rising geopolitical tension, conditional access is unacceptable. Industrial economies cannot function if critical inputs depend on rivals. Energy transitions, defense production, and advanced manufacturing all require reliable material flow. This is where the flow reversed. Instead of competing for silver in global markets, supply was secured closer to home. Agreements were restructured, volumes were redirected, refining capacity was pushed to its limits. The result was a bottleneck that could not be explained by price alone. To an analyst looking only at charts, nothing made sense. Price did not reflect urgency. Volatility did not reflect scarcity. Yet physically, the system was under strain. This is the hallmark of a structural shift. Structural shifts do not start with price spikes. They start with logistics. They show up as inefficiencies before they show up as inflation. They reveal themselves through behavior that prioritizes control over cost. This phase marked a turning point. The silver market stopped being neutral. It became segmented. Silver in one region was no longer interchangeable with silver in another. Location mattered, jurisdiction mattered, access mattered. The old assumption that metal could always be sourced from somewhere else began to fail. This created a new dynamic. Once supply chains begin to regionalize, competition intensifies. Each system seeks to secure its own needs first. Excess capacity disappears, redundancy shrinks. Efficiency is sacrificed for resilience. This is not a temporary adjustment. It is a reordering. The decision to absorb more silver domestically was not a reaction to price. It was a reaction to risk. The risk that reliance on external supply could become leverage in a broader conflict. In such conditions, speed matters more than optimization. Redundancy matters more than cost. Stockpiles matter more than return on capital. The flow changed direction because the rules changed. And when flows change, markets follow later. This reversal also had a secondary effect. It exposed how thin the visible market had become. With more metal staying within one system, the remaining pool available to global markets shrank further. That shrinkage increased sensitivity. Small disruptions had outsized effects. Lease rates rose, delivery times lengthened, premiums appeared where none had existed before. Still, many dismissed these as anomalies. They were not anomalies, they were symptoms. This was the moment when the silver market entered a new phase. A phase defined not by abundance, but by allocation. Not by price discovery, but by strategic preference. Those watching physical flows understood what was happening. Those watching only prices were left behind. In the next part, the focus shifts to the market signals that began to break down entirely, and why traditional indicators stopped working at the very moment they were needed most. When market signals stop. Telling the truth, markets rely on signals, price, volume, hedging, inventories. Together, they create the illusion of clarity, but when the structure beneath a market changes, those signals begin to lie. This is what happened to silver. For decades, silver behaved in ways analysts understood. When prices rose, producers hedged. When volatility increased, inventories adjusted. When supply tightened, premiums appeared gradually. These patterns formed the foundation of every model built around the metal. Then, quietly, those patterns broke. The first sign was subtle. Commercial hedging began to fade. In normal conditions, large buyers protect themselves. They lock in prices. They smooth volatility. Hedging is not optional. It is standard practice. Its absence is not neutral. It is intentional. As hedging activity declined, many assumed confidence had increased. Others blamed regulatory changes or temporary dislocations. Very few asked the obvious question: why would a rational buyer stop protecting price risk? The answer revealed a deeper shift. Price risk had become irrelevant. Access risk had not. A buyer who hedges plans to trade around price. A buyer who does not hedge plans to hold. When possession becomes the objective, volatility becomes noise. This was the moment silver stopped behaving like a traded commodity and started behaving like a strategic asset. At the same time, inventory data began sending mixed signals. Official reports still showed metal in vaults, but the quality of that availability changed. Some inventory was pledged, some was leased, some was technically present but practically unavailable. Ownership mattered more than location. Markets continued to treat all ounces as equal. They were not. This mispricing of accessibility created false confidence. It suggested abundance where there was fragility. It suggested liquidity where there was congestion. Then came backwardation. In commodity markets, backwardation is a stress signal. It indicates immediate demand for physical delivery. It reflects urgency. When persistent, it suggests structural imbalance. Silver entered this condition not briefly, but repeatedly. Lease rates rose. Borrowing metal became expensive. Delivery windows tightened. These are not speculative signals. They are physical ones. Yet prices remained restrained. This contradiction confused analysts. How could stress exist without explosive price response? The answer was control. When supply is privately secured, stress does not express itself immediately in open markets. It accumulates internally. The visible market becomes a thin surface stretched over a tightening core. Traditional indicators fail in this environment because they measure activity, not intent. Intent had changed. Large participants were no longer optimizing for profit. They were optimizing for continuity. They were not trading silver. They were warehousing it. This behavior breaks models built on liquidity assumptions. When participants stop recycling supply back into the market, availability shrinks even if reported inventories appear stable. Silver was being removed from circulation, not sold, not dumped, not hoarded in panic, simply taken out of reach. This created a dangerous lag. Prices did not reflect scarcity because scarcity was not being expressed through auctions. It was being expressed through absence. The market was still quoting a number, but that number described fewer and fewer real transactions. For decision makers, this environment is treacherous. Signals that once provided early warnings now arrive late. Risk accumulates quietly. When it finally surfaces, it does so abruptly. This is why silver began reacting sharply to minor disruptions. A small delivery delay caused outsized reactions. A modest inventory draw moved lease rates significantly. Sensitivity increased because buffers were gone. This fragility was not obvious on screens. It was obvious only to those handling metal. The disappearance of hedging was the clearest confirmation. It signaled that buyers no longer feared price movement. They feared losing access. This is the defining characteristic of strategic accumulation. History shows that when markets enter this phase, volatility eventually follows. But it follows after control is established, not before. By the time prices move decisively, the window for easy access has closed. Silver was approaching that point. Part 4 marks the breakdown of trust in market signals. Not because markets failed, but because their purpose changed. They no longer coordinated trade. They reflected residue. In the next part, the story expands beyond silver itself, into the financial system that now needs it for reasons far more fundamental than industry alone. When silver stops being a metal and becomes collateral. For most of modern history, silver occupied an awkward position. It was too industrial to be treated purely as money, too abundant to command the respect of gold, too volatile to be trusted by institutions. That position no longer holds. What changed was not silver itself, but the system around it. The global financial order had entered a phase of quiet stress. Confidence, once assumed, now required reinforcement. Payment systems were fragmenting. Trade alliances were shifting. Balance sheets were being re-examined not for return, but for resilience. In this environment, collateral matters. Not symbolic collateral, not paper claims, physical collateral. For decades, the system relied on the same answer: gold. It sat at the center of reserves, settlements, and confidence. When uncertainty rose, gold absorbed it. But gold has a problem. There's not enough unencumbered gold to meet the demands of a multipolar world. Much of it is already claimed, pledged, or politically sensitive. Every central bank wants more, and very few are willing to part with what they hold. This creates a gap. That gap is where silver re-enters the system. Silver is tangible, it is divisible, it is globally recognized, and, unlike gold, it is embedded directly into industrial supply chains. This last point matters more than most realize. Silver does not sit idle. It moves through energy infrastructure, electronics, and manufacturing. It connects finance to production. As collateral, it does not just back trust, it backs output. In a world moving away from single currency dominance, this linkage becomes valuable. Alternative settlement systems require assets that can be verified, delivered, and repurposed. Silver meets those requirements. It can sit on a balance sheet without being consumed, yet it remains essential to real economic activity. This dual role changes demand behavior. Buyers seeking collateral do not behave like investors. They do not rotate out. They do not sell into strength. They accumulate and hold. Price sensitivity disappears. This explains behavior that once appeared irrational. Paying premiums above spot, refusing to hedge, locking supply for years regardless of cost. These actions make sense only when viewed through the lens of collateral security. At the same time, governments began reassessing material classifications. Metals once treated as commodities were being redefined as strategic inputs. Energy transitions accelerated this process. Defense considerations reinforced it. Silver crossed an invisible threshold. Once a material is treated as strategic, market logic changes. Access becomes prioritized over efficiency. Domestic control becomes more important than global optimization. Stockpiling becomes policy. This transformation also alters risk calculations for businesses. Supply reliability becomes a competitive advantage. Those with secured access gain stability. Those without face exposure. The market price does not reflect this shift because it cannot easily quantify it. Collateral demand is opaque. Strategic accumulation is quiet. Governments and institutions do not broadcast their balance sheet adjustments, but the effects ripple outward. As silver is absorbed into long-term holdings, liquidity shrinks. As liquidity shrinks, volatility increases. As volatility increases, the remaining tradable supply becomes more sensitive to shocks. This is how a metal transitions from abundant to critical without a dramatic shortage headline. The financial system feels the change first. Stress appears in funding markets, leasing arrangements, and settlement costs. Only later does it appear in consumer-facing prices. By the time it does, positioning is already complete. This is why silver's role as collateral is the most underestimated part of the story. It explains why strategic actors are willing to pay premiums. It explains why supply chains are being locked down. It explains why traditional demand metrics no longer apply. Silver is no longer being accumulated for upside. It is being accumulated for assurance that obligations can be met, assurance that production can continue, assurance that independence can be maintained. This demand does not disappear with a price correction. It persists through volatility. It survives cycles. Once silver enters balance sheets as collateral, it rarely returns to the market. Part 5 reframes the entire conflict. This is no longer a contest over a metal. It is a contest over trust, resilience, and future optionality. In the final part, the consequences of this shift become unavoidable, and the narrowing window for response becomes clear. The closing window and the cost of late understanding conflicts over resources do not end with announcements. They end when access is secured. By the time policy becomes visible, the decisive moves have already been made. This is the final lesson of the silver conflict. What appears sudden to markets is usually the result of years of quiet preparation. Silver had already crossed into that phase. The physical flows had shifted. The hedging behavior had changed. The inventories had thinned. The buyer profile had transformed. What remained was formalization. This is where policy enters the picture, not as a trigger, but as confirmation. Governments do not impose controls on resources they do not already influence. Tariffs, classifications, and restrictions are applied after supply chains are reshaped, not before. This is why policy signals often feel late. When authorities act, they are not reacting to markets. They are locking in advantages that already exist. By the time regulations are discussed openly, the underlying control has been established. For silver, this creates a narrowing window. Businesses that rely on uninterrupted access to critical materials face a new reality. Procurement strategies built on global liquidity are no longer sufficient. Just-in-time assumptions fail when supply becomes conditional. Cost minimization gives way to continuity planning. The question shifts from how cheaply can this be sourced to from whom can it still be sourced? Those are very different questions. This shift carries consequences across industries. Manufacturing timelines become less flexible. Input costs become more volatile. Contract terms tighten. Strategic partnerships matter more than spot availability. For financial actors, the implications are equally significant. Models that rely on historical correlations weaken. Risk appears in places previously considered stable. Price no longer leads behavior. Behavior leads price. Late understanding is costly in this environment. Those who wait for confirmation through headlines or official statements find themselves competing for residual supply. Premiums rise, optionality disappears, decisions become reactive instead of strategic. This is not a forecast. It is a pattern repeated throughout history. Resources that become strategic follow the same path: quiet accumulation, supply segmentation, policy formalization, price adjustment. The order rarely changes. Silver is now at the final stage of that sequence. This does not mean immediate crisis. It means constrained choice. The system does not break overnight. It tightens gradually until flexibility is gone. For decision makers, the risk lies not in price movement, but in misinterpretation. Those who continue to treat silver as a normal commodity will be surprised by its behavior. Those who recognize it as a strategic asset will adjust before pressure becomes visible. This moment rewards foresight, not speed. The closing window is defined by time, not price. Once supply chains are fully regionalized and collateral positions are established, the market becomes secondary. Access is determined by relationships, jurisdiction, and alignment. At that point, price is merely a reflection of outcomes already decided elsewhere. This is why silver's transformation matters beyond the metal itself. It signals a broader shift in how the global economy organizes critical resources. Neutral markets give way to strategic blocks. Efficiency yields to security. Liquidity yields to control. Those shifts do not reverse easily. The final warning is simple. When a material becomes strategic, waiting for clarity is a mistake. Clarity arrives only after options have narrowed. The visible market will always lag the physical reality. Silver has already moved ahead of its price. 5 years from now, observers will debate when this change truly began. They will point to charts, policies, and events, but the turning point will not be found there. It will be found in the moment when buyers stopped caring about price, when supply stopped flowing freely, and when access quietly replaced cost as the dominant concern. That moment has already passed. The Silver War did not begin with a crisis. It began with contracts. And it will not end with a crash. It will end when control is complete.